Hello friends, a very warm welcome to Canara Robeco Connect program. I am Gaurav Goyal and I am in conversation with Mr. Shridatta, Head of Equities, Canara Robeco Mutual Funds. Welcome Shri.
Thank you, Gaurav, for this monthly connect. Hello, investors.
So Shri, I think let me just start with you. We had a very big event recently which has happened, the Trump 2.0. Uh, how do you see that impacting the global economy, the markets, and particularly the impact on the Indian markets?
Sure. So, I think there are two ways to think about it. Fundamentally, there are two schools of thoughts. One school of thought is Trump 2 would be significantly different than Trump 1, whereby what he is alluding to in terms of tariffs, in terms of protectionism, in terms of bringing back jobs to US, on immigration, on geopolitics, getting out of a lot of disputes globally and focusing more on America, that would play out to a great extent. And if that plays out, that I think would be a negative thing for the globe in general, because what it would mean is that for last 30 years, 40 years, the supply chain realignment that was happening, the US consumer who was actually leading to global growth in terms of merchandise goods, the unipolar world whereby while there were disputes, at least there was one guy who could intervene and actually resolve them, or at least not let the dictators to take shape in a lot of places. I think that would set to change. This is one school of thought which is very, very extreme. We are of the belief that it will be the second school of thought that will play out most likely, which is would be more like Trump 1, where you are fundamentally a transacting guy. You want to extract the best outcomes for US nonetheless. So you start with a very, very aggressive positioning in terms of tariffs, in terms of geopolitics, in terms of defense deals, in terms of the energy related aspects. So you go very aggressive and then you actually negotiate the best case for US. Our take is it would be more of a second scenario rather than the first scenario, whereby yes, at the margin there would be certain aspects which would be good for US. There will be certain aspects which would be good from an energy perspective. There will be certain aspects which would be good from defense cooperation perspective. And now I'm talking about this is from India's perspective. That's the most likely outcome in our view. India, in a way, is a very, very small trading partner. India's fiscal current account deficit with US is very small. So even if some tariffs were to be put, it won't hurt us as much as it should hurt some of our other peers. And so to that extent, we should be net beneficiary, be it trade, be it the defense cooperation, given that the entire new administration is anti-China. There should be hopefully de-escalation in both the wars that are going on.
Correct.
And which means little better environment for both energy prices and supply chains, which again turns out to be positive. So net we are seeing, unless until the first scenario plays out, the first school of thought, it should be net positive from our perspective as we see it.
Okay. So Shri, I think one aspect which is people have been talking about from Trump 2.0 and which we have seen is in terms of the FI flows going back to the US, and it's like it's going from all the markets, and so if you don't get that FI flow and if this trend continues, then how you see the Indian market getting impacted?
Sure. So I think this is the first reaction to the event, whereby contextually, given the kind of yields that are there in US and the kind of earnings growth is there, even from a fundamental perspective, it is not looking like a very bad option. But we still feel that it is a immediate reaction to what has happened, and the first level of thinking whereby everybody is thinking that they will cut corporate taxes, there will be more growth in US, the fiscal deficit will be cut,
Corporate
profitability will be better, and that's where the capital is flowing back, because anyways there are very limited choices apart from India and few of the other countries where earnings growth is relatively resilient in both developed worlds and emerging markets.
Correct.
Our take is this is not a surprise. This is the first level of reaction to any event. But as again I said in the previous question, as you go through the time, people will realize that a lot of these things are far difficult to do rather than just kind of assuming that that will happen. For example, cutting US jobs, government jobs and saving 2 trillion, it would lead to US consumer recession effectively. So is it practical? Both from political perspective, economic perspective? No. Can you put huge amount of tariffs? No, it will lead to higher inflation, so you can't do that. So there are a lot of nuances, second, third derivatives of what is being talked about, but the first reaction naturally is in US for next 2 years it is projected that you are going to have 10% earnings growth. Your tech companies anyways are doing well, doing a lot of innovation, and on your debt side you are getting probably almost 5% risk-free returns, and that's where capital is flowing back. Had there been better options, probably you wouldn't have seen it so strongly, but since there are very limited options and on top of that, that economy generally is not doing as bad, that's where you are seeing this reaction. Having said this, can a stronger dollar and a higher interest rates a good outcome for US? In our view, it's a very, very suboptimal outcome for US because the global central bankers and global private capital incrementally is not as willing to fund the US deficit. And if that is the case, keeping higher interest rate is only going to hurt the US government because they have to pay effectively higher interest rates. Which means at some point in time, and your inflation is already running at just 2.5%, which means you are running a 100 to 50 basis point of real interest rate, which is like akin to tightening. So anyways, invariably it should lead to slower growth or slower inflation. But even if that were not to happen, it is in the interest of US actually to have lower interest rates and let the currency go. So our take is most likely, and some of the viewpoints are suggesting that as the time passes, they will let the currency go. So dollar will not be as strong. So they will let the currency go, but let the interest rate remain lower in domestically in US because the domestic Fed and private capital is funding the government spending. So that's how we are looking at it. So it's far nuanced. What you have seen is all first leg of reaction in the absence of very, very strong global markets or strong emerging markets. But let us see how calendar year 25 pans out. And our sense is as you go through calendar year 25, there will be a lot of disappointment on some of these aspects in US.
Okay. So coming to the Indian economy, of course, the Indian economy is one of the fastest growing economy. It's like an oasis in the deserts. And of course, we are now the 5th largest economy. In next few years, we are going to be the 3rd largest economy. But one of the trends recently, when you look at is coming down, and is that we are seeing the GDP growth rate is slowing down. Even the inflation forecast by RBI, they have increased their forecast there. We have seen a slowdown in terms of the earnings momentum also. So your take in terms of what's happening in the Indian economy and how do you see the earning growth momentum from here?
So we are looking at this year as a basically contextual or cyclical moderation than any structural issues to worry about. Because if you actually step back and think about last 3, 4, 5 years, post-COVID, it is the government which took the center stage.
Correct.
Government started driving the capex. The public capex has grown at almost 20% CAGR over last 4, 5 years. Naturally, in calendar year 24, particularly around election, when government's decision making slowed down as they were in election and then monsoon happened, the public capex has slowed down a little bit. Of course, it will moderate from where it was. But even for this year, what was projected, the first half has been much lower than that. And that has led to a little bit of a slowdown because public capex was one of the key pillars in driving both the economic growth as well as the earnings growth. Having said that, there are other pillars and our sense is, and that's where I said it is more contextual, our sense is those pillars will show up gradually. In any economy, the textbook play generally is that you get public capex, which crowds in private capex, real estate, and then eventually you get job creation and consumption. This is typical business cycle. Our view still is that we are in a business cycle from an Indian economy perspective. It started in 1920, but since COVID happened, it got a little delayed. So we're barely in 2-3 years of business cycle. There are no excesses that we see. When we look at various pillars, this public capex most likely will translate into private capex. It's not as if private capex is not happening. It is just that private capex is not happening at a pace where market will be happy with that, given what market has penciled in. Private capex is happening at a 10% CAGR. A real estate cycle is doing fairly well. At least the top 10-20 cities, the real estate cycle is doing extremely well. Consumption is a weaker part, particularly the mass consumption. Of course, it is nuanced. The luxury affluent class consumption is doing well, mass consumption continues to be poor. But our sense is this is a contextual slowdown in a structural economic cycle, whereby what you are seeing is that as heavy monsoon happened, as government slowed down during the election period, you are seeing the earnings slowing down in part of the market, particularly when the rural or mass consumption was not very, very well funded. The next leg we see is a combination of private capex, real estate, and inherent redistribution of money from government with the central election outcomes towards rural poor, urban poor, and consumption, which is reflective of the kind of freebies or inherently transfers that have happened, which is about 3 lakh crore rupees by 12 states as of now, which annually will be put in the hands of the mass poor, which should also translate into incremental consumption. So we see that consumption has bottomed out, exports has bottomed out, real estate is doing anyways healthy, private capex is doing well, it just needs to do far better than where it is from a context perspective to take up the pace. Public capex, yes, public capex government will be more focused on fiscal consolidation. So public capex one should expect probably at a 10% CAGR rather than 20% CAGR going forward from here on. But when you take combination of all these things, we don't see a reason to believe that on a structural basis we should go back to 5.5% growth. Yes, we will be lower than 7.5% what we reported last year, or 7.3, 7.5% that we reported last year. But as private capex, as exports, as consumption starts actually moving up, you should get back to around 6.5% of growth, which is, and 4% of 3.5-4% of inflation, which is including deflator, which is about 9-10% of nominal GDP growth rate. That's on the growth side how we are looking at it. It is, in our view, clearly a contextual part rather than a structural slowdown in the economy. Inflation, I think it's very, very seasonal. It's completely led by food inflation, because the core continues to be at 3.6, 3.7. As long as core doesn't pick up, I don't think we should worry about the inflation part. So it should kind of resolve itself. The only problem is because of what is happening in US, the incremental lever of monetary policy at the pace at which it would have been otherwise available is unfortunately is not available now. It will get a little back-ended rather than front-ended. So I think that's how we are actually looking at the overall economic landscape from calendar year 25's perspective and 25-26 perspective.
Also, Shrib, just help us understand, because when you look at India is one of the best performing emerging markets, and when you look at in terms of the last decade, one of the interesting trend is that, okay, while DIs and the retail investors they are buying more of India, and they have increased their holding. FIs on the other side, there is, continuous, you can see that from 23-24% of holding, now they are at about 17-18% in the last one decade. So how do you explain, because, on one side, the weight of the Indian markets and the emerging market index is actually doubled in the last one decade. So while the weightage is doubled, India is one of the best performing emerging markets also, both in rupee terms and in dollar terms also when you look at. But the FI ownership is continuously reducing. So is there any message in this data, or
no,
how do we read this?
I think it has predominantly happened in last 2.5 years. So if you look at the FIs or last 4 years, calendar year 20, when the valuations were attractive and the risk reward was extremely good, they did put in sizable amount of money.
Correct.
But after that, it has been on and off. So net it has resulted into hardly any flows over the last 3 years. People get excited time to time, but it is like 2 months of outflow, 2 months of inflow. But net, it's not a very large number. How I read it is more statistical. One, that of course the domestic financialization of savings is happening at an aggressive pace, and if somebody is buyer, and if somebody is buyer at any valuation, somebody has to be seller. It can be only promoter or FIs, given that they were the largest existing shareholder.
Yeah.
The second aspect to look at it is where the shareholding was of FIs. FIs shareholding in India was predominantly in the concentrated large cap space. On a relative basis, that space was not doing well. FIs were not significantly present in the broader market. The market capitalization of the broader market has actually increased significantly just as an outcome of higher return versus the large cap as a category. And within large cap also, predominantly they were present in certain financial institutions, which was a concentrated holding, 5-6 names, which in terms of earnings did underperform for a period between calendar year 22 to 24. And naturally, it was underperforming part of the both domestic market as well as in a lot of portfolios context globally also.
Yes.
And that's where you are seeing that people have been actually lightening up that part of the portfolio. Unfortunately, even if FIs want, a lot of businesses in terms of liquidity, they can't actually create sizable position, and that's where you are seeing that persistent reduction. If I have to take a hunch, our hunch would be that largely you have seen those drawdowns. And we are seeing that we have seen those drawdowns because the earnings in those part of the market where they were present predominantly and which was hurting them has largely on a relative basis bottomed out. And now you have started seeing the journey on the other side gradually. And as that happens, and those are the only 100-150 companies where FIs are predominantly present, I think they're, if the valuations are selectively attractive, I wouldn't be surprised in second half of calendar year 25 if we start again seeing a rescaling of some of these weights. From a MSCI perspective, it is more statistical because the global funds would have sold. And that's where, while the MSCI index funds would have bought, but the global funds would have sold, and that's where your net holding would have gone down.
Okay. So coming back to the Indian market cap, so of course there are various components and they have actually behaved differently. So of course in 2024, when you look at micro caps have done better than small caps have done better than mid caps, and then then large cap, mid caps have done better than large caps in terms of the return experience to the investor. How do you see that panning out in 2025, and what are your views across all these market caps?
I think a lot of this was to do with the starting valuation point and starting earnings expectations. I think a lot of that inherent margin of safety in micro cap or mid cap or small cap has largely been leveled off. So today no more market is expecting very low earnings growth, or the valuations of this part of the market are very low. Just to put it in context, both mid cap and small cap are trading at micro cap, so you don't get very good consensus numbers, but mid cap, small cap indices are trading at anywhere between 1 to 2.5 times of higher standard deviation in the historical valuations. Right. Which doesn't mean that those part of the markets have to fall. It only means that either the earnings CAGR has to be significantly higher than the large cap as a part of the market, or the valuations have to adjust itself through time, price, or earnings rollover. Our sense is the relative risk return reward has turned gradually in favor of top 100, 150, 200 companies versus the broader market gradually. It is sheerly because the pace at which last year both the earnings were in that part of the market on relative basis and the valuations as outcome have reacted based on the liquidity that has flowed into that part of the market. Today when we look at, we see that whether it is broader market or whether it is large cap, we see earnings growth of anywhere between 10 to 15% CAGR. So the earnings growth divergence, say for example in financial year 24, you had Nifty earnings growth of 23-24%, and you had BSE mid cap small cap index earnings growth anywhere between 30 to 35%. That gap has been narrowed down completely, and starting valuation, which was
they are converging.
They has completely converged. So now it will be, I think, far more bottom, and that's where even in one of my other conversation I said calendar year 25, calendar year 26 likely to be far more nuanced, far more bottom up, far more individual stocks, and what part of niche even within the sector is doing better than the rest based on the earnings, rather than the themes like what you saw last 2 years where you had individual themes like PSUs did well, so all PSUs did well. You had small caps doing well or micro caps doing well, so all of them did well. I think not that some of them will not do well, but it will be far more specific in all parts of the market. it will be far more nuanced because the earnings normalization has happened. The valuations are at a relatively higher valuation, except large cap. The earnings normalization has happened towards probably historical averages. And in that case, then you need to find out individual securities who are going to beat the averages rather than a broader space as such. So that's how we are looking at it across all categories.
Okay.
But we would be tilting towards large cap and selective domestic cyclicals.
Okay. Also, coming back, winners keep rotating in the Indian market, and particularly from a sector's perspective. So, you have leaders and laggards every year, which keep on changing, and that's really very, very dynamic, depending upon what valuations those sectors are trading, what are the views which are coming there. In 2024, we have seen pharma, real estate, auto. Some of these sectors have been industrials have been the leaders. FMCG, private banking, media, they've all been laggards. How do you see this, in terms of the sector rotation in 2025, and what is your view in terms of, in view of your corporate earning growth, which we are looking at in terms of sectors, which will be the leaders for 2025?
So I think calling out sectors is always very difficult, but how we can look at it is where the earnings are likely to move.
Yeah.
What part of market has margin of safety in terms of valuation, and what part of the market has superior earnings growth but doesn't necessarily have the margin of safety in terms of valuation, which means it has to continue to deliver superior earnings. So when you step back and think about calendar year 24 and part of calendar year 23, you had domestic cyclicals which were at the forefront, X of large lenders or large banks. Everything else was domestic cyclicals. Within domestic cyclicals, what we are seeing is part of that will continue to do well. Yes, of course, there will be a little bit of a consolidation. But like what I said, it is a business cycle or it is a credit growth cycle, it is an economic cycle. Similarly, when a sectoral cycle plays out, it doesn't necessarily stop typically in 1 year. Yes, sometimes valuations go out of whack, and so there has to be consolidation, like what you saw in IT, yes, particularly mid-cap IT in calendar year 22. Calendar year 21 was extremely good. Calendar year 22, it had consolidation, and then again it started its journey. We see some of the domestic cyclicals like industrials as most likely, or power value chain most likely to play out like that. That it is a longer cycle, it is a industrial part of the economy, it is a longer gestation segments of the economy in terms of execution. So while they are expensive and they have done exceedingly well, over medium term, they're likely to continue to do well. But there is limited margin of safety in terms of valuation. So earnings growth delivery is what one has to watch out for. There are other parts of the domestic cyclicals, for example, market infrastructure plays, auto, where we are gradually becoming a little more circumspect for multiple reasons. Auto volumes are slowing down after being very, very strong for 2 years. So nothing wrong from structural perspective, but in calendar year 25, they will have a low single digit volume growth. So that space within the domestic cyclicals, we are actually watching very closely in terms of any surprises on negative side. Market infrastructure plays have done exceedingly well, but most of these businesses are available at 15p, 20p. Now on an elevated earnings expectation, all of them have moved to 30, 40p. So that's another domestic cyclical space where we are watching it very, very closely, and we want to guard ourselves. Hospitals, to some degree hotels, aviation, telecom, these are smaller niches, but doesn't look like there is any earning challenges. So we continue to be positive on that part of the market. Pharma is one space which is defensive, but a play on low raw material costs globally and a decent FMCG like top line. Again, valuations have increased there also. It has done exceedingly well, but a good compounding story at a portfolio level in our view. You have to pick and choose the names, but that again so when I look at this basket on domestic cyclical side, auto and market infrastructure plays are two spaces where we would have reduced, or we are turning less and less constructive. Rest of them, you will do a portfolio adjustment, but we continue to remain constructive. Within the defensives, telecom, pharma, you continue to remain constructive. Global cyclicals, IT is something where the margin of safety was very good. So you actually we have changed our position about 6 months back and turned almost neutralish in that sector, but still not overweight, because we want to see actually whether BSE 500 companies really get earnings upgrade, revenue growth upgrade or not, because that's the story as of now, that's the narrative as of now on which the sector is doing well. There are sectors like FMCG or mass consumption, which can be a dark horse, which has a huge margin of safety in terms of both ownership and valuation as compared to their own historical valuations. But unfortunately, the drivers are not in place. So timelines can be little extended, or you have to be very, very choosy in terms of what part of the mass consumption you pick in terms of incremental positioning. But that is one space which I think one needs to watch very, very closely incrementally, which has not done well, but can do well. Chemicals is another space which one needs to watch closely, which is a small sector but need to watch closely. Commodities, energy, as a house, we don't believe it is our forte. Yes, they are, a lot of them are cheap. Valuation margin of safety is there, but we are not sure about sustainability of the and longevity of those businesses. On a top-down basis, the globe continues to slow down, energy transition continues to happen, China continues to slow down. So it's very difficult to make a positive case on core commodity sectors from a fundamental perspective. So that's how we are looking at the entire market. If I had to call out, probably combination of industrials and consumption is what I would say I would bet on as sectors to still watch out for. One has done extremely well.
Rural consumption is also improving now.
Rural consumption, mass consumption, which is not the other one, which has not done well at all. So that's how we are looking at it.
Oh, great. I think the last question, Shri, I think when you look at industry, and if I look at in terms of where the investors have invested more in 2024, so clearly on the equity allocation side, people have actually taken bets on thematic funds, small cap and mid caps incrementally, in terms of the mutual fund portfolios. So in 2025, what is your advice to all our investors and partners when they have to incrementally look at which fund strategies they should consider for the incremental allocation on equity?
I think, of course, the investors should consult their advisors first, because we are the manufacturers and we are offering products. But within our own manufacturing basket or product basket, we find that risk reward in categories like large cap, flexi, aggressive hybrid, consumption fund, focus fund, value fund, which are products which are tilted towards probably at least 65-70% large cap or 60% large cap at least, and max large plus mid as a category. Those are the products where we would tilt towards. But of course, it's a function of the horizon that investor has, the volatility appetite investor has, and the return expectation that investor
their
has.
own asset allocation,
And their own asset allocation. If it has tilted really towards one side, they need to readjust that. I would strongly urge that anybody who want to continue to invest in a broader market should have a longer horizon and should do it through SIPs rather than doing it in a lump sum manner. So I think that's how we are looking at it internally.
Thank you very much, Shri, for this insightful discussion. I hope all these perspectives help our investors and partners when they are looking at allocating in 2020.
Thank you, Gaurav. I enjoyed the discussion. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.